And, the conversation has really changed from the last time we spoke based on that better jobs report last Friday. It now seems that investors are unsure of what the Fed's going to do. And something that you've been hearing out there, and we've been hearing more generally, is what is the strike of the Fed put now? What are your thoughts here?
Yeah, I think it's a little bit of a rhetorical question, of course, as people debate the action of the Fed and lack of action of the Fed and all of what goes into pricing equities with that in mind. So that's the big debate in the market right now. And I think if you look at the Fed funds futures market in the WERP screen on Bloomberg, you get a good sense for just how aggressively that's priced right now. Yeah,
well, we actually do have a great terminal chart here of the July meeting in particular, where I think the odds are still pretty high that a cut will take place. But they're certainly coming off of, they're becoming less so as investors think that maybe is off the table. What do you think? Do you think that the Fed cuts in July or not, and why?
Yeah, the last time I looked at the screen, it looked like about a 95% chance that that we were going to get a 25 basis point cut at the end of July at the regular meeting, and about a 4% chance that there was going to be a 50 basis point cut, really leaving no room for them to just hold. And that's why we get into this cycle of what's bad is good and what's good is bad, as we saw with the jobs numbers at the end of last week, when we saw a pretty strong number and the equity market actually sold off a little bit. It gives you a little bit of an idea of the sensitivity of the equity market to potential pause from the Fed.
Well, of course, Fed Chair Jay Powell will be testifying before Congress tomorrow. Do you think that his script has changed a lot from, say, last Thursday to what we'll hear tomorrow? And do you think it'll be market moving?
Yeah, I think it's going to be market moving no matter what. And I think that his script is a little bit dynamic, and as it should be. So, we take the opinion, and when we talk to our investors and clients about things, that the Fed seems to be sort of like the parent at the candy shop, right? Like, do we need that or do we want that? And I think the Fed is looking at more of what the market needs, and there are some other branches of the government that are, saying that they want certain things, and they're sort of holding on tight to what the market really needs.
And so if we relate all of this to the SPY, or the S&P 500 ETF that's so liquid and so well traded, you did send us a chart that shows both the V-bottoms back in December of last year and then more recently in May. Can you talk to this as it relates to, again, the strike of the Fed put?
Yeah, sure. So at the end of Q4 of 2018, the sell-off was sort of stalled by accommodative language from the Fed, which was, we're going to hold off on raising rates, that we're going to pause. And that pause and that accommodative action and conjecture is what stalled the equity and risk-off mood. When we went into sort of a sell-off at the end of May, the same thing happened when the market was digesting the potential and the probability of actually going to lowering rates. And now we're at a point where there's contemplation of lowering rates not just by 25 basis points, but by 50 basis points. So I think we're pretty aggressively priced in the equity market for very favorable Fed action.
Great stuff.